Hey traders, Stephen Kowitzel here with thetradersplan.com. It is Wednesday, December 26th, the day after Christmas. I hope everybody had a Merry Christmas, and we got another holiday coming up, so a lot to be cheerful for, just not in the stock market. So I really from the bottom of my heart wish everyone had a Merry Christmas, good family time, good eating. Lord knows I did, and I'm trying to get back in the gym, but I want to, this webinar might be a little bit longer because I just have so much to cover. I did not do a webinar last week. I was on vacation. I took the family to Disney, and this is a weekly chart, and look what happened the week I was gone. So just may think it was just kind of the perfect time to take a break, because I definitely didn't have to worry about trading or anything like that. But we're going to start with the weekly chart on the NASDAQ, just to kind of I think it's important to look at a longer term chart, because right now the day-to-day action is so sloppy. You want to get rid of the daily noise, and I think you need to do this right now on your individual stocks, right? In your individual stocks, it does help to look at a weekly chart, because, I mean, if you pay attention to all the day-to-day gyrations, and even the the daily bars that are just wide and loose and sloppy, I mean, if you don't have an automated system on an automated plan in place, it's enough to give you a heart attack. So we are in a bear market, and this is nothing new. And we're going to look at this. We're going to look at some other bear markets. We're going to look at just absolutely everything. So I promise you will not, you won't have a lack of information, a lack of things to think about. But the important thing is, really, to me, is when you're in a bear market or you're in a nasty correction, to really pay attention to what's possible, right? Looking at past corrections, looking at past bear markets, and how you might handle them. We're not trying to get in on the exact bottom, or we're not trying to get in the exact top. We're trying to catch the meat of the move, right? And this is a great chart, and you can kind of see a little mini head and shoulders. You had that double dip correction in 2015, early 2016, but one point I really want to hit you with is great trends come out of nasty markets. And I mean, just look at this. So you had a great trend right here. I mean, it was a little choppy, but if you hung in there, you did pretty well. This is a phenomenal trend. And that's why, if you have a systematic process in place, you got to take them all, because you don't know when you're going to get just a 40% move. And, then your stocks are probably tripling during this time. You just don't know when that's going to happen. So if you have a process with a statistical advantage in place where you're the house, you need to stick to that process, because it's just like the 80-20 rule. 80% of your profits are going to come from 20% of your trades. And we don't know which one is going to be the big winner. Sometimes we think we do, but over the looking at over 100 trades, you probably have some big winners you wouldn't have guessed would have done so well. So have simple rules, make it mechanical as possible. So right now we're looking at the NASDAQ, and it has corrected about 24%. So I think that's clear sign that we're in a bear market. I like to sometimes just define a bear market as if the short-term moving average, the 10-week, is under the 40-week, or the 50-day goes under the 200-day, and you get that death cross. Really the same thing. We're kind of splitting hairs, but this is just the weekly chart version. So that happened right here, and the market was here. And look, right around this one support level, it came back and it just slammed down. Like, you had a couple of really strong days, hit that long-term moving average, that 40-week, and just got slammed down, and then just started the waterfall, right? The waterfall where it's just taking out stops, running them all. In a correction or in a bear market, sometimes you kind of want this to happen. And I don't mean to be insensitive for your long-term positions or your long-term portfolios, but you want just everybody to be so disgusted with the market. But if you have a plan, you should have had a lot of cash like me. But if you had a plan, you can get out. You could have got out a long time ago. It's using simple moving average rules. Simple moving average rules. It doesn't have to be complicated. But in a downtrend, supports are going to get broke, right? In a good downtrend. So when you're in a good uptrend, you can plan on support holding, support. And then it starts to get tired, support breaks, okay? So then you had a clear change in personality, and then it never could retake it. And then it sold off, and it sold off really, really quickly. So let me see if I can update this. So now, I mean, it's only Wednesday, but we kind of got this reversal working in the NASDAQ on the weekly chart. The volume is probably going to be light just because of the half day on Christmas Eve, and then you got the Christmas and all that good stuff. But a 24% correction, that is really good. Now, I'm going to tell you this, really it's best to just avoid, you know, all these nasty bear market predictions. I think it's okay to, you know, listen to some people and say, okay, when this has happened, here's what has happened in the past, and we're going to look at some of that here in a minute, because that's all you can really do. Like, in a similar situation, and none of them are exactly the same, because you don't have the exact same traders trading the exact same positions, right? This is fear and greed right here. But I can't imagine that, you know, you nibbling down here with a tight stop under it. You know, it doesn't have to be a stock. It could just be like an ETF or something like that. Something that's a little bit low risk with a stop under it. I can't imagine that would be, you know, too bad of a trade. But I do not recommend loading up on leverage ETFs or backing the truck up with a bunch of positions, even though we probably could get a strong bounce coming out of this. But the market is just, it's too nasty. But we could get, you know, a bounce up into one of these, what was support could now turn into resistance. And I'm kind of looking at this 6,900 level, which is, if we get a strong bounce and the market comes up to the 6,900 level, that 10-week moving average is probably going to meet it. It could be a real test, but even when you get these strong rallies, they're not V-shaped. Okay, they are not V-shaped recoveries. It could, you know, do another washout low, bounce really hard, and then, you know, hit resistance, and then probably chop around a bit, which would be my guess. My guess is that you're going to get a bounce, and then it's going to come back, and then just start being sloppy. Best to avoid the slop and not try to trade it. And, you know, you can have some simple rules like, hey, I'm going to wait to start trading until the NASDAQ or the S&P 500 is above the 20-day moving average. 20-day moving average is a nice trending moving average, and if it moves below it, you're out, right? The trend is over, the rally is over. It's just a very simple rule, and that's what I'm trying to do. Trying to put tools in your back pocket where you don't have, there's no guesswork. There's no guesswork. You know, where the bottom or the top is, you just have simple rules. All right, and whipsaw is a part of trading. Whipsaw, you're going to, I mean, you can make a lot of money only, you know, making money on 50% of your trades as long as you keep your losses small and you have, you know, a 3-to-1 or even a 2-to-1 ratio. You're going to do very well. But protect the downside. Don't start loading up unless you have a plan, a very specific plan. So the NASDAQ clearly broke multiple levels of support, and there really is none. Okay, now it's just the NASDAQ is going to do what the NASDAQ is going to do. Just like right here, you know, you had this double market correction, and then all of a sudden it broke out, correction's over, and then you have this nice trend. A lot of slop, and these are very strong rallies. These are very strong counter trend rallies. Like, you're going to get, you know, a 7 to 10% counter trend rally, and then it could roll over, and then another 7 to 10 counter trend rally, and then just chop around. So again, just make sure you have your rules. And I think the best way, we're going to look at some bear markets before I get into that, but let me go look at, let's go look at the NASDAQ. So this right here, this is a zigzag, a 20% chart, and this is the NASDAQ going all the way back to 2008. And all this is doing is showing every straight line that is a 20% move in the NASDAQ. Very simple, right? So what this means is, even towards the bottom of the bear market in 2008, disclosure, I'm not calling this a 2008 by any means, so don't even think that. But you had a 20%, like just a surge right here, and then another a minimum of 20% down. So you had all these 20% moves towards the bottom, and then boom. Then you got the big one. Then another 20%er, and then boom. Now this is the NASDAQ, so the S&P 500, probably you're not going to have as much 20% zigzags, but every straight line is a minimum of 20% move one way or the other in the price action. So really, you have this monster trend going all the way back from October of 2011 to the peak in October of 2018. So 7 years where you did not have a bear market, and then you got one. Okay, but even with all this zigzag, all these 20% corrections, if you just would have bought and hold, and I'm not a fan of always buying and holding, but unless it's a long-term stock with some dividends, all that gravy stuff. But if you just would have bought and hold, you'd be up 100 even when you get this, right? Same time frame. You would be up 133% in the NASDAQ, right? The NASDAQ, out of all these 20% moves, 20% corrections, even this 20% correction, you're still up 133%. So sometimes it's important to take a step back and look at the big picture and see, okay, yes, we are in this move, but look, when the chop is done, major move, okay? And then actually, I kind of want to put a little price action on this. Nope. Just to kind of show you. So then at the bottom, you had a 125% move right there. Straight, boom, okay? In the NASDAQ. And then you have a monster move right here. So 253% move. I'm kind of wondering this number isn't matching down here. Oh, that's why. That's because it dipped below it. So, and that's just the interesting thing. That's why you want to try to have a rule to kind of get at the bottom, because you have 126% move at the bottom of 2009 before it went into another bear market. Then you have a 253% move from October, 7 years, a 253% move. That's from about 2,300 all the way up to 8 grand. So that is, I mean, that's a fourfold, you know, fourfold difference, almost, probably 3.5, 3. But man, these are good moves. So my point is, I'm just trying to show you that when the slop is over, when the bear market is over, you can get some mega moves. So don't fall asleep. Don't get pissed at the market. Don't, you know, worry about any of that. If you follow the rules, if you've been following me, you should have plenty of cash. You should have plenty of cash to take advantage when you get a signal. And even if you get a buy signal and then the market decides to roll back over and you get stopped out, that's just a whipsaw. But you can see right here, the trends are greater than the whipsaws, okay? It's going to happen. So I just think this is a phenomenal chart just to show you of what is possible when you're coming out of a bear market, okay? Good stuff. It's really good stuff. Let's just look at the S&P 500. So a couple weeks ago, you know, we had a series of lower highs, and I talked about this being a descending triangle, and typically, I don't remember exactly where I was when I shot this video, but it was somewhere in here, somewhere on this leg, and typically that is a continuation to the downside, and then the continuation happened, right? Just waterfall, nasty city all day long. So you can see that right after, and this is a good point to make. You had, right after you had that major, I can't remember if it was the Fed pop or the Chinese, whoops, that's not what I was looking to do. The Fed pop or the Chinese pop, where the market was up huge, then everybody thinks we're getting out of this, and then it just gets slaughtered 16% in the S&P 500. So, you know, again, it didn't break the pivot, right? So the uptrend didn't, you know, it didn't negate this downtrend. It got slammed down. And once you see that slam down, you're like, that's not right. That shouldn't happen in an uptrend. And then support started to break, and one of the nastiest waterfalls. I mean, that's a pretty nasty waterfall. That bear market in the S&P 500 took every bit of, here, let me kind of try to inspect this. So let's just call it on this day to this day. How many trading periods is that? It's about 2 months. I can't find the number. Sometimes that number is hiding on here. Okay, there it is. I see it. 56 trading days. So in 56 trading days, we went from all-time highs to 20% correction. Man, that can fall, and that can fall quickly. again, rules. When the market started to break the 50-day moving average right here, you should really start to be raising cash at the very least. A little bit of cash, at the very least, a lot of cash. So let's just look at some market breadth. I did want to... Okay, we already looked at that. Let's just look at some market breadth real quick. We'll look at the short term and then the long term just to kind of show you how bad it is. So the S&P 500, 0.2%, this is percent, 0.2% of S&P 500 stocks are above the 20-day moving average. 0.2%. There is no trend. There is no rally. We could get a bounce off the bottom, but no rally here. Financials, 0. No, excuse me. Technology, 0. Financial, 0. Discretionary stocks, 0. Industrial, 0. Healthcare, 0. A darling, no longer. Staples, conservative, 0. Energy has been 0. Materials are a little bit about 4%, so that's still not a rally. And then XLU fell off a absolute map. XLU was looking really strong. It was bucking the trend, and then boom. And that just kind of goes back to my webinar when I was talking about, is it really worth it to investing in conservative stuff just because the market is going down to try to clip your 2, 3, 4% coupon, whatever? That can get wiped out in a day, and it did. I remember when the REITs and the utilities, they were down 3.5% a day. Whatever dividend you thought you were getting got wiped out. So to me, cash is a position. Cash is a position, so it's okay to have cash. Let's go look at some more S&P 500 breadth. This is the percent of stocks above the 200-day moving average. 9%. 9.8% of the stocks are above the S&P 500, above the long-term moving average. That's pretty nasty. It undercut these corrections right here. At least I believe they did. Let's kind of throw an inspect button on there. Absolutely it did. In this nasty double dip correction, it was about 19-20% of stocks remained above the long-term moving average. Now we're at 9. Okay? Not good. The percent of stocks above the 50-day moving average are very small. And the percent of stocks above the 20-day moving average are even smaller that we just looked at. So there is no trend, nothing to see here, no rally here. If you want a bottom pick, that's fine. If you pick a bounce day, you put a stop immediately under that, and then you sell in a strength, okay? Sell in a strength. If we look at the high-low breadth indicator, this is the net highs versus minus the net lows. Look at all this red in the S&P 500. I mean, that's pretty bad. When you get below 10, then you need to start to be cautious. It's corrective action. We're at negative 44. The mid caps, negative 47. And the small caps, negative 38. So it just kind of goes, and then you have the NASDAQ 100, negative 33. So much net new lows are going on right here. Again, follow the trend. If you were to see a strong uptrend, you would be investing in stocks and want to capture that. If you see a small downtrend or a strong downtrend, I'm not a shorting guy unless I'm trading futures or something like that, but you really just want to sit on the sideline and wait for some kind of signal, some kind of reversal in the market. Pick a day and just start with a small pilot position. But the breadth, there's really nothing, absolutely nothing good about it. Okay, now gold is looking really interesting right here. Let's start with GLD. Let me get this inspect button off. So a couple weeks ago I said, hey, it looks like it's starting to climb the right side of the base. And it is. So you have the right side. It broke out of this bottoming base right here. It's climbing higher, climbing higher. It broke out, came back, tested this little 117 level. This is the GLD ETF. and is starting to move. Excuse me, should have turned off my phone. But gold breaks out. In my opinion, that's a breakout. So now we have the GDX, okay? The GDX right here, that you have a lot going on around. This is just a zone around the 2050 to 21 area. So you could say that it surged up, had a little bear flag or bull flag, broke out, and it's got to eat its way through this. But gold is moving higher. Miners are sloppy just because that's just what they are, sloppy. They're like my kryptonite. I swear, every time I trade them, I just don't like it. But, you know, it's gone nowhere. It's gone nowhere. It's gone nowhere. Look at how many times it touched this level. You know, 6 or 7 times, and then it broke. And now it's probably got to do the same on the upside. It's probably going to come back, touch it a couple times. But if we go down here, you got the miners versus the metal ratio. You want, in an uptrend, you want the miners to outperform the metal. So now you have the miners are outperforming the metal right here. Broke out of a downtrend. I could also draw a horizontal breakout right here, and it's eating its way through it. So it's not like, I mean, it's not super exciting or anything, but it is trying to move higher. It's breaking out. It is getting a little sloppy. But what's interesting is you have this ratio right here, and then you go down to the dollar, the USD, that's been on a monster run. And I think momentum is really slowing to the downside on the dollar, because you can see that it was strong, and then you had a fake breakdown. If I were to draw a trend line right here, fake broke down, but it continues. But now it's really slowing. You can kind of tell, hugging this trend line. I think it's going to break. If I were just a betting man, I would say this is going to break. Could just be a consolidation, though. You know, there's a lot of technicians that look at this differently. They could just say, well, it's just consolidating right here. That could most certainly be happening. But so you really need a definitive break. But I think if the dollar is very close to making its decision, and if that's the case, the dollar could break. That could make miners, metal, international stocks outperform significantly. So we're going to look at that here in a minute. But gold is looking interesting. Miners are looking interesting, and I think you really need to start taking a look at this, because I think there is enough evidence with the dollar showing some weakness, hasn't had a definitive breakdown yet. Miners are outperforming metal. The GDX is trying to eat its way through a very, very interesting 21 level that found support about 100,000 times. No, I'm kidding. But about 6-7 times. So it probably, I wouldn't be surprised if it comes back and then takes another stab and punches through. And then you have GLD that is breaking out clearly and changing the trajectory of the metal. What else? I have so much. Okay, so let's look at the S&P oversold, RSI 5. Okay, so in these last 2 corrections, last 3, you're getting these double dips, even triple dips of, you know, the market, RSI 5 on the weekly chart. And every time, typically after the last one, it was around the bottom. Look, it bottomed right here, but that doesn't mean that it just took straight off to the moon. There was some more ugliness, but then you had a double dip in the RSI oversold right here. It was right here. Wasn't the exact bottom, but the fact that it made new lows and the RSI oversold did not. It's a positive divergence right there. And then you had a monster multi-year trend where it really barely broke the long-term moving average. A couple whipsaws. So then you got this right here, double dip, came out, very, very nice trend. Now you got a double, now we're in a triple dip. So you can see it barely came below it. So you have this dip right here, which was earlier in the year, and now we are in the oversold territory on the S&P 500. Now I warn you because these oversolds, they can stay oversold for a long time, just like in a bull market, as you can see up here. They can stay overbought for a long time. In my opinion, and even in research shows, if you're going to use a tool like this, it is best to buy as it's coming out of the oversold instead of just waiting till it gets, you know, deep, 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 because you don't know how deep it's going to go. It's just like you don't know how high the market's going to go. You don't know how far, you know, the market's going to fall. So, you know, you have to have a trend following mentality. Like, you got to expect the market to, you know, just keep going down until you get a signal. And the same thing on the upside. You got to let your stocks just move and move higher until you get a signal that it's starting to break down. So, you know, just follow your rules. There's plenty of easy signals out there, and, you know, use the moving average system. Use a simple moving average system. Let's look at the SPX and the CRB. Is this the one? No, that's not the one. A lot of SPX. All right, here we go. Here we go. So this is a very long-term chart, and this is a relative ratio chart. I don't think I pulled this up in a while. So this is the relative ratio chart between the SPX and the CRB, the commodities index. So commodities, or the S&P 500, they go in cycles where they can outperform or underperform for a significantly long time. So this goes back to 1990, and you can see that when the line is going up, the S&P 500 is outperforming commodities. The line is going down, the S&P 500 is underperforming commodities. So from from this time frame, 90 to 99, the S&P 500 returned 266% versus commodities of 19%. This is why I do not believe in buy and hold commodities, just because they can be out of favor for a decade. Okay. Now you have the in favor, right? Then you're starting to make a series of lower lows, right here, which really signaled a new downtrend a new outperformance of commodities. So from 99 to 2011, 12 years, the S&P 500 returned about 6% a year, or 69% cumulative, and the commodities returned about 6% per year. And the S&P 500, which for some odd reason I mistyped that, returned negative 8%. Use a relative ratio chart. Which one would you rather be in? Which one would you rather be in? You can look at, you just use the old eyeball chart to say, okay, clearly that this is in an uptrend or in a downtrend. Then you had a breakout of that downtrend, meaning S&P 500 is now outperforming commodities again. This has been going on since November 11th of 2011 to present. This is updated numbers. So during this time frame, the S&P 500 is clearly way outperforming commodities, 87% to negative 47%. You know, that's about 134% outperformance. Which one you want to be in, right? You could just use a simple, you know, breakout, breakdown, trend lines, relative ratio. Like, man, be in the strongest one. Because if you loaded up on commodities right around here, you're cut in half still. You're cut in half still. Okay, so here's what to look for. Here's what I'm looking for. I'm looking for a undercut of a pivot for this trend to potentially change. Now, right here, I wouldn't really call this kind of a pullback, but you had a pullback and it started to undercut these pivots right here, and then you had a surge. Now you're kind of getting this double. I would say that if commodities, this relative ratio comes down and it hits 13, I would say that's a clear trend change, and I would say that you need to be more commodity conscious than U.S. stock conscious, because it could be a decade where we have inflation, commodities are, you know, going up, inflation's going up, and you're beating stocks because you're just following a simple relative ratio chart. This is very close to undercutting this pivot. I wouldn't say that's the end-all be-all, but I would say if it undercuts this pivot, clear trend has changed, okay? And sometimes these topping formations, they can take a year, okay? So it's not a straight, you know, this is a monthly chart. This isn't all of a sudden one day, now you need to move everything from stocks to commodities. All I'm saying is I'm trying to broaden your horizon a little bit to give you a different picture, a different point of view, to make sure you can use a simple momentum style of investing to outperform over a significant period of time. This is a very long-term chart. And it's interesting because when commodities outperform, right, when this line is going down, it means the S&P 500 is underperforming, commodities are outperforming. Same thing with emerging markets. That means emerging markets is outperforming. Dollar's going down, Gold's going up. So all these relationships hold true. And now we're kind of waiting to see if gold can come back, because it's been in a 6-year bottoming base. It broke out right here, but then it kind of failed. But, you know, this 1300 level, maybe a little bit higher than 1300 level on a GLD or on just a gold futures contract, that's pretty significant, because it goes all the way back to 2013. I think that could open the door for a pretty significant commodity run. So just keep your eye on that. I hope that was a good chart for you, because I absolutely love that chart. Let's look at some bonds, because bonds are screaming higher along with gold. So there is a risk-off environment. This also has to do with a lot of interest rates. But look, you have, bonds peaked in August of 2016. You have this downtrend, touch 1, 2, false breakout, and now the 4th time is the charm. That is a definitive breakout. So the TLT, and there's other bond, ETFs you can use, but a lot of them are very similar. 4th time. So it's wear you out, 3rd time, oh, well, that's good, nope, psych. And then you got the 4th time, and then it just starts to go off. So again, something to pay attention to when bonds are just beating the market. This could be something significant for the upcoming year. So just kind of keep that in mind, that now, even though you could get some major rallies and that could pull back bonds, but this is breaking out of a 2.5-year trend line. So it's not something to be taken lightly, okay? It's worth paying attention to. So if we have the USD, so again, so here's the interesting thing. So typically when the dollar is strong, the U.S. markets outperform international markets. So these are relative ratio charts. Well, the dollar is starting to weaken. I wouldn't say it's breaking down, but you did just undercut these two pivots on the U.S. dollar on the weekly chart. So you had a nice head and shoulder breakout. You had a nice cup with handle, second stage, and now it's starting to undercut these pivots. Could just mean it needs more time to consolidate, or it could just absolutely roll over. If it does start to roll over and pick up steam to the downside, you're going to want to be in more international and emerging markets, because you can see right here, let me just put some inspect on this. So you can see about right here we'll call it right here, when the relative ratio started to peak, meaning all of a sudden, since this time frame, early November, international and emerging markets started to outperform the S&P 500, because when this is going down, it means it's outperforming the S&P 500. When it's going up, it means the S&P 500 is outperforming. So you can see right here, when the dollar is really strong, you got these strong outperformance of international, got the strong outperformance of international, and now you have kind of a breakdown, kind of a switch. So, and we'll look at that here in a second. So let's go straight to that. So my point is, start to pay attention to more inflation or more international. So let's just look at SPX perf chart a little bit. Maybe I click the go. VU. Let's just throw an AGG on here. Last 20 trading days. Okay, so in the last 20 trading days, you can see that the VEU, which is the All World Vanguard ETF without the US, is only down 7.5%, 7.24. The S&P 500 is down 12%, and bonds are up 1.5%. So when you have the international stocks that were just getting smoked by the U.S. stocks, there's a big divergence going on. Now, all of a sudden, the international stocks, you have the crossover right here, are going down less. What that tells me is the likelihood of when we come out of this bear market, the international stocks could lead the way. And I have more evidence. I don't want to look at that. SPX versus VEU. So let's look at that. So you saw that. Siren's going off. So that just means, okay, so right here, so you have the purple line that is the VEU, right, ETF, the international stocks versus the green and red, which is the S&P 500. There was a clear divergence, right? They crossed. You could see they were going in line, not 100% neck and neck, but they were following each other clear. Then all of a sudden, right in here, and this is really when the dollar started to get strong, international stocks started to sell off. International stocks started to sell. But there was a very wide discrepancy. What is that? A 12% discrepancy in the prices. Something's got to give. And a lot of times what happens is, and this is just kind of an early warning sign, doesn't mean that I'm going to go out and sell everything because international stocks are selling off, but international stocks will go first. U.S. stocks typically go last. So you could see right here, when there is a huge discrepancy, they're going to have to come together. Either international stocks are going to have to start rising, or the U.S. stocks are going to have to start falling. Typically, historically, because international stocks fall first, then we can see what happened right here. So it's just been grinding down, and this has really, really been nasty. So since the top of, so this VEU was down 20% since the top. So both in bear markets, but if we go back to the previous chart, you'll see that in the last 20 trading days, international stocks are not down as much. They're actually down about half as much. And with the dollar momentum slowing, it could just be consolidated with momentum slowing, gold looking strong. To me, it appears a setup for international stocks to maybe take some leadership sometime in 2019. Well, I've gone over a lot. What else we got? Let's look at the VIX. So, a couple weeks ago, I talked about, Nicholas Darvich book, How I Made $2 Million in the Stock Market. It was written back in the 50s. But, he talks in terms of boxes, right? Something will trade in a box and then it'll move up. And then the top of this box will find support of this box, and then so on. So I drew these boxes a couple weeks ago, and then boom, it busted into another box. Now, is this just a washout low, or is it going to pinball around in another box? I don't know. My guess is that it's kind of a washout low. It's just running every possible mommy and papa's, yours and my stop that is possibly still in the market. Because if we look, so you got the 20, and if the VIX is above the 20, you need to be cautious. Or if it's hovering around the 20, you need to be cautious because there's some fear in the market. But right here, now you have the 30 level. So now we have extreme. So you could see back in 2015, you had that extreme up to 40. Was very close to the low, if not the low. Maybe not quite the low, but very close. And then earlier this year, the VIX popped to 37, so above 30. That was the low of the year until you hit the new low, okay? So, again, is this a washout low? Is it going to do what these other two did? And, maybe bounce for a little bit, but just kind of go sideways for a couple months. So the last two times this has happened, you're close to the bottom, but then it has rallied. This doesn't look like much of a rally, but it's a strong rally you want to trade. But then it rolled back over until we were completely out of this correction, and then it broke. So I want to go back. So we'll just kind of wait and see. We're so oversold, we'll do for bounce, but I wanted to come back and look at a couple things. So in the last, we're looking at a seasonality chart. In the last 20 years, December has historically been up in the S&P 500 70% of the time with an average gain of 0.4%. So November and April are actually the strongest months, and then you need to sell, and then on average, the June, August, September, even January or February, typically on average, the last 20 years has negative months. But one thing, so 70%, right? So one might say, okay, if December is supposed to be so good and 70% of the time it's up, yes, the odds are in your favor, but don't ignore the other 30%. That doesn't mean you buy and hold in December. You need to have a rule for that other 30%. What happened in the other 30%? Was it really bad? I'm seeing articles saying we have the worst December since the Great Depression. Yeah, that's true as far as pure price action, but the month isn't over, and I wouldn't read too much into that. It doesn't matter to me if it's a bad December or a bad January or a bad, April. Like, you can always find an argument to say, oh, this is the worst since the last crisis, blah, blah, blah. So I wouldn't put too much emphasis on that, but just what I'm showing this to show you, don't forget the other 30%. Now, if I go to, let's just say, oh, NASDAQ is up 3% today. So if I'm going to show you, okay, let's just look at, let me just look at the NASDAQ. There is and I got some, I'm about to blow your mind with a fact, maybe. So the rule is, and right now I'm looking at the Stock Traders Almanac 2017. There were 33 occurrences so what happens is you have a December low right here. And typically what has happened, and this is going all the way back to 1952, there were 33 occurrences where in the first quarter, try to follow me for a second, 32 occurrences were in the first quarter of the following year. If it undercuts the December low, then you need to be careful. Okay, so I'm going to repeat. If in the first quarter of the following year undercuts the December low, on average since 1952, that has happened 33 times. So on average, an additional 10% from this low has continued to correct. So we just got to be cautious. Got to watch out for this low. If it is taken out in the first quarter, all out of the 33, all but 2, extended their further declines. Okay, just by an average of 10.5%. So what that means is first quarter, if the December low gets taken out, on average, you are going to have an additional 10% decline. Now, these are just numbers. These are just kind of numbers I'm throwing at the average drop. However, don't let that freak you out, because 19 of the 33 of those occurrences also ended with a positive year. So even if in the first quarter our December low gets taken out, and then what that means is on average, all but 2, have an average continued further prices of about 10%. But 19 of those 33 instances, you still would have ended 2019 a positive year. I know that's kind of a lot to think about. But so right now, we're just kind of going to look at this low. And if we get a bounce and then it goes back lower in 2000, the first quarter, you just need to really be cautious and let it run your stop. So if you're buying here, you got to stop right here, let it hit it, stop, and just get out of the way. Okay, so I thought that was some really, really kind of interesting historical facts in the Trader's Almanac that it's just kind of good. You can go buy it for like $30, and it's just got a bunch of historical facts on what the markets have done. And that typically goes all the way back to the beginning of the century, the 1900th century. So that's very interesting. Let's look at oil for a second. Okay. Not much to talk about, guys. This is West Texas. On this, before it even tried to bounce, it was down 60%. This is down 46%. It had a multi-week, I don't know what to call that a rally, but just an ugly bounce. Again, if you're going to play the bounce, fine. Put a stop right under it. I don't care if your stop is in the most obvious place. Put a stop under it, because then that would have saved your bacon on another 10 to 15%. You'd be out. Maybe you lose 5%, but you saved yourself 15%. So I don't know what to say about oil, but it's not looking good, and I'm not really looking at playing an oversold bounce right here, just because I can look at this and say, I mean, there's better things out there. Not a lot of better things out there now, but it is. So if we go look at, let's go look at Treasury yields for a second. So even though they're raising rates, the yields are going down. Starting to, let me see if I can show. So you have this really, really long going back to 81 downtrend, and I would call that a definitive breakout, but now it's undercutting. You can see it's undercutting this, which means it could be a false breakout. And, you know, typically what Martin Pring of StockCharts.com says, and what he said makes a lot of sense. If you have a false breakout or breakout to one side, it's usually an above average move in the other. It could mean it's an above average move to the downside, which would put further pressure on banks, because banks are mostly positively correlated, or financials, with the interest rates, and are negatively correlated with utilities. It should help utilities, but utilities are looking weak right now too. So it's just kind of something to keep our eye on. If I can kind of blow this up just a little bit, you can see that it's trying to undercut this. So you know, consolidation is fine. Even a pullback is fine, but be careful if it just kind of goes all the way down. So let's, you know, one thing I want to look at, actually, I want to go back to the NASDAQ chart. And I want to look at a very, very long-term chart, but I want to show you, I don't think that this is going to end up too nasty. I'm totally giving my opinion here. But I think it could slop around for a while. Actually, let me throw a start date on an end date. You can see right here, let's just look at the 2008. When you had that death cross, you know, it never... Actually, give me a minute. I want to show... Let's go back to January 1st to the 2009. Okay. So you have, these are extreme examples, right? But we are in a bear market. So let's just kind of look at what the possibility is and how we could play a rally. So you have, you know, just a nasty, nasty correction. This is the NASDAQ. So the NASDAQ was down a lot more than everything else. But my point is, actually, I wonder if I could go to the SPX. I think that would be a more realistic. Okay. So my point is, this 10-week moving average and the 40-week moving average. The 10-week is the blue line. So when you get rallies, right, and this is just slop all the way down, but when you get rallies, you don't know which rally is going to come out and which rally is going to work. When it falls back below that 10-week moving average, if the 10-week hasn't crossed above the 200-day, but it crosses above the 10-week, but then it falls back down, this is your exit. Okay? Because let's look at this again. So then it just gets slaughtered again. Then you get a nice bear market rally. And this is a legit rally. This is a 30% rally. Okay? So you can have bear market rallies that big. But it never made it to the long-term moving average. You never had the golden cross. And then it broke the 50-day moving average. There's your exit. You don't have to ride it all the way down. Get out right there. Get out right there. And then you have another one. And then, oh look, then you have another bear market rally. And again, this is a strong, strong rally. But then it cracked. Okay? You never had the golden cross, and then it cracked below the 10-week or the 50-day, whatever you want to use. And you need to keep getting out. So I'm just going to kind of repeat the rules of how you want to play this. When you're in a death cross, and then you get a rally above the 10-week or a rally above the 50-day moving average, whichever one you want to use. If you're still in a death cross and then markets start to crack under that 50-day moving average, you need to get out of the way because it's ready to take another leg down. Same thing right here. You had the peak in late 2007. You had a bear market rally, nice little 15% rally. Found resistance at the long-term moving average. But let's just say you bought here as it busted through, then you got out as it broke the blue line. Okay? So again, you could have protected yourself. And right here, you get a rally, you're immediately out. Whipsaw. Okay? Same thing right here. So you get a lot of whipsaw, but if you want to play the bear market rallies, all I'm telling you to is if you're still in the death cross, don't let your stocks or your index or whatever it is you're trading roll back under that 50 or 10-week moving average, you just need to get out of the way, because history, all these examples are showing that you would have been right to get out of the way. So one example, two examples, 3, 4, 5, and then it started to chop around at the bottom. So, and this is what the bottom of bear markets look like. They are just chop and chop and chop and chop, and they can take months and months. Then you had your golden cross. Then look at that. Look at that strong. So if you should play the golden cross, death cross, you're out right here, which means you get out down here. So you're not out at the very top. You're not in at the very bottom, but man, who the heck cares? You just missed all that. All that. You just missed it, right? Go fishing and protect your capital and, live to invest another day. It takes a 100% gain to make up for a 50% loss just to break even. So I just kind of wanted to show you that real quick. I want to show you some scan, and let's look at some miners that are looking kind of interesting. Oh, I know why this is blurry, because I need to kind of reset this. Why does it look like that? Okay. Alright. Are we good? We're good? We're good. Okay. So let's just look at the weekly chart. Just kind of smooth things out a little bit. But look. So you have a rising, starting to really outperform relative ratio. You have, this has been in a downtrend since, look at how quickly it can move, by the way. 14 to 52, that's a hell of a rally. And then it just broke. But look, you can ride that 50-day or 10-week moving average, never broke, never broke, never broke. Broke, you're out. And then avoid all that crap. But momentum is definitely slow to the downside. And now you have a box around some of these, looks like a bottoming pattern right here. So momentum is slow to the downside. That blue line is starting to curl up. You got some volume coming in. It's going to test that 40-week moving average, but you got relative outperformance. So silver and gold miners are looking kind of interesting if you're looking for a play. I would just kind of keep in mind that if we go risk on again, these are going to probably pull back. Same thing with Ring. This is the iShares Gold Miners. You can also use GDX, whatever. But with Ring, looks even better because if I annotate this, you had a nice little surge up, nice little bull flag, broke out of the box, is trying to break through the long-term moving average. Look at all this accumulation right here. So something is happening in gold miners. And if you want to get on the ground floor, how do you play this? What price is it now? $16. Don't let it roll back below $15.50, right? Right where that blue line is. 16, $15.50, you're risking not a lot. If it falls back in, if it does break, then it's just going to fall back into the bigger consolidation, right? And it's not going anywhere. So all I'm saying is use a tight stop. That's like a 3% stop for a potential to make a move, okay? So that's looking pretty interesting. Now, what's doing good? Let's go to the market's doing pretty good. I needed that. Some of my long-term positions need a boost. But let's just kind of go look at the scan. Let's go get a new scan. And here, I want to start with stockcharts.com. I wonder if these scanning tools can be free. Maybe the scanning tools aren't free, but I would assume that a lot of you at this point in time, additional tools reports probably do have some sort of, even the cheap version of a stock chart scan. But let's just create a new scan, and all I'm looking to do is see what is holding up there. So let's just say, okay, if you're in the S&P, where's the S&P 500? Okay, let me add that. Let me add a technical indicator. Let me add a rate of change. So what this is a 12-period rate of change of greater than 0. So anything that's positive in the last 12 days. Let me run that. not a lot of stocks, but I mean, this is a good fit. This is a good honey hole. When the market is down, all you can say is, okay, the rate of change is a very pure indicator, just saying like, what they're up. If this was a rate of change of 5%, a 5 would be a 5%. So you got a 12-period rate of change. Anything that's in the positive territory, Broadcom. And then you could rank it however you want. Broadcom, O'Reilly's, Dollar General. These are very, these three right here are very defensive in nature. Mining, Newmont Mining. Let me look at that and just see what that chart looks like. Pretty sloppy. I don't know about you, but that's kind of sloppy for me. Let's look at Broadcom. Sloppy, but looks interesting. Let me see if I can throw a weekly chart on this to kind of clean up some of the noise. So you have I know I saw Broadcom. I know you had an earnings report right here. Big volume, pulled back, and is now sitting on the clusters and moving average. That might not be a bad entry. But the relative ratio to the S&P 500, it's been outperforming. You can see this rising line. It's been outperforming the S&P 500 the whole time. Little bumps and bruises, but the whole time. So not something bad to look at. So you have some pockets in the retail that is not looking all that bad. That doesn't look too good. That's not what I want to see. What if I were to... I'm kind of go back and edit this. What if I were to say last 20 periods, anything up? Okay, there it is. One stock. One stock is up 5% in the last 20 days in the S&P 500. Newmont. What if I were to just change this just a little bit and say, okay, 14, 5%. Let me check the syntax real quick. Syntax looked good. Run scan. Nothing. Interesting. Okay. But you get the picture. I mean, you can do just a very simple group as 500 or, and just to see what the strongest is. Now, you can use scooter values. You can use relative strength lines. But I think rate of change is kind of the purest just because it focuses on price action. In the last X, Y, Z days, what stocks in the S&P 500 are up X, Y, Z. However you want to run that. So I hope this was helpful. I know we covered a lot. Right now, I would just be incredibly cautious. We could get a bounce. If you want to play the bounce, you put a stop right under Monday's low. No questions asked. Just let it happen. If it runs your stop, so be it. If you want a bottom pick, put that stop in under. Always follow the rules. And if I go back to, let me just kind of go back to the NASDAQ real quick. Just to kind of show you if we do get a bounce, a good bounce, and it gets above that 50-day moving average, I would sell it if it breaks it and if it rolls back over. Because what I think would be healthy is if we're just chop around at the bottom for a little bit, give these moving averages time to kind of curl down and catch up because you had such a big waterfall. And then when it breaks through it, I think it's going to be more likely to hold because the market was digesting down here this waterfall.